All right, hello everyone. Thank you for attending this webinar. My name is SeeWing Yee from the Yee Real Estate Network, and our company specializing helping mom and pop investors, regardless of where you live physically, in anywhere in the U.S. You have the ability to buy out-of-state property, buy in a way that are turnkey with property management in place, houses available for you to pick, only sell for investors, all cash flow properties, very, very easy to manage and economize. As a matter of fact, all the management has been done for you. So you as a part-time investor can buy multiple properties over time and still does very, very well without, without any stress of associated with real estate investing. Anyway, with that said, my special guest speaker is Mr. John Chen, someone I have known for many, many years. We have done business over the years, off and on, and he always come up with some big projects. Since I've been doing this for almost 20 years, I have the privilege of meeting many, many mentors and partners and high-level real estate investors that have been there, done that have gone through various up and down real estate cycles. So they speak from a world of experience, wisdom, knowledge, and people I respect very much. So John Chen is that one person, and not only he have great knowledge on everything, but he also have some projects and opportunities for our investors as well. And I can't wait to hear what he has to say. So before he will go through the unique opportunity he has for our investors, he's gonna take a 10-minute high level sort of a review of what's going on out there in the real estate market. So he has a very good perspective. So I challenge you to just listen intently, because he had a lot of great values to provide. Everything's very real, very practical. It's not fluff, is not just overhyped information. You get out there in the YouTube video world, most people, they just want to promote their video channels through doom and gloom information just to scare people. Anyway, so with that said, Mr. John Chen, welcome. Thank you for your time. I know you're very, very busy doing so many great projects. So what's in your world? What's your perspective on what's going on in the real estate world?
Yeah, before we came on, SeeWing's saying that he was asking, what can you share that's just practical for like a regular mom and pop investor? We work in the capital world and with institutional clients, but I love working with individual investors more than anything. And so I always try to bring it down to that level. Like if I was talking to one of my family members who wanted to buy a house and rent it out, right? And you talk about, you can do everything right, but if you do it at the wrong time, then you get hurt. So a lot of it's about timing, as well as just competency in general. And so, I've been burned enough in the past and have done things at the wrong time. Now I'm just hyper defensive and very skeptical and protective. And so we're always looking at things from a defensive position, right? So it's like, okay, what could possibly go wrong? What are some of the signals that could point to red flags or potential risks? And if there are, how do we mitigate or minimize them? And so that's kind of how we look at the market. So everything I share is from that perspective. And that's just from being cut and bruised and banged up from doing things wrong or at the wrong time, right? Or doing things right at the wrong time. So right now, the big question is, what's going to happen with the market? Where's the market now and where's it going? And what's the evidence of that, right? So speaking from where we are right now, I can say that the way we keep pulse, and I just did a video on this today and shared it with our YouTube family, but the way we keep pulse of what's happening with the market, considering all factors related to supply and all factors related to demand, is at the end of the day, what is housing inventory doing? And so what is that inventory situation at any given point in time? And then if you plot all those points, because you're tracking them on a regular basis, how is it trending, right? Because the trend is even more important than just a still picture or a snapshot of what things are looking like right now. So just this morning, and it only takes us like 3 minutes to do in our particular market, we happen to have one of the largest MLS systems or database of properties for sale in Florida through the Central Florida MLS system. And so at any given time, like pre-COVID, if we go back to February of 2020, we had about anywhere from 35 to 40,000 active listings. That's how big our MLS spans, right? Some MLSs are smaller than that. There are very few that are larger. So it's a pretty encompassing MLS, a really good sampling size, at least of the Florida markets. And then we'll take the temperature from that MLS of what's happening with inventory, meaning we look at what the sales pace has been looking like on a weekly basis. We take an average to figure out, okay, what is our sales pace tracking at on a monthly basis? And then how many houses or active listings do we have now? And if we didn't add one more active listing to the market, for example, let's say you had 10 houses available, and if you were closing at 5 per month, that's what you were tracking at on average, then it would take you 2 months to sell those 10 houses. So you'd have 2 months of inventory. So that's essentially what we're tracking on a weekly basis, not just in our markets, but we take a sampling different markets around the country. So we look at parts of New York, we look at Colorado, we look at New Mexico, California, parts of Texas, and of course, our backyard is Florida. So multiple spots in Florida. And that gives us a really good kind of a snapshot on a weekly basis of what's happening around the country, so that we can see if there is a slowing trend. Is it happening? Is it a local thing, or is it happening nationwide? And so the headlines right now are kind of pointing to a slowing in the market. And it could be because, most likely because we're at the end of the summer. And it also could be due to what they call buyer fatigue, because buyers are just getting fed up, especially your first-time home buyers and people who have to do high leverage loans, FHA or VA, and they're on the lower end of the price scale. They can't get away with bringing a lot of cash to the table like other power buyers can, especially buyers who are selling in high cost of living markets and moving to lower cost of living markets, like selling in New York, coming to Florida, or selling in California and going to parts of Texas or to Tennessee, for example. So what we see now is we were tracking, let me go back, before COVID, we had, like I said, 35 to 40,000 properties at any given time. So let's just call it 40,000 to use easy numbers. And we were selling about 10,000 a month, 2,500 properties a week. So that was the pace, 10,000 a month, 40,000 active. So the month before COVID, we were at about a 4 months of inventory, 3.5 to 4 months of inventory is kind of where we were floating. Fast forward, and at the peak of the summer, when everything was most hectic, not just in Florida, but around the country, we were sitting at around 2 weeks of inventory, 3 weeks of inventory, because we went from having a sales pace of about 10,000 a month to doubling that to just under 20,000 sales a month. And we had a fourth of the inventory. So instead of 40,000, we may have had 10 to 12,000 active listings available. So it would take us only 2 to 3 weeks to exhaust that inventory. And so 0.7 months of inventory, exactly where we landed. And we were sitting there for probably the last 8 weeks. As of this morning, we saw it go up to 0.8. So I'm going to continue to watch that to see if that's kind of a thing that's showing us that we're coming out of a hectic market and slowing down. But that's just the quantitative feedback. And that's just a quick data-driven snapshot that we can do. And we're seeing that around the country. It kind of mirrors what we're seeing in the headlines as well, as far as house sitting a little bit longer. You're actually seeing people buy at list price, which is funny to say, because the norm was you had to pay more than list price to get a house, and you would be in a bidding war. But I was just looking at an article today about, if you look at how the market is doing just by virtue or measure of the bidding wars In other words, how many properties that are on the market that go pending had a bidding war on them or multiple offer scenarios, that percentage has gone down. So we were at, across the country, at a peak of about 72% in May. And in April, we were at an all-time high of 74%. That means 74% of all houses that were listed on the market that went pending were on the backside of a bidding war, right? Multiple offer scenarios. Well, that rate just dropped to only to 65% now. So we're seeing a little bit of a cooling in that regard. We see a cooling based on the quantitative metric. When we look at the housing inventory on MLS, that's true in multiple markets around the country. And you're seeing less bidding wars, a little bit more days on market, but it's not that much different than it was in the summer. It's just slowing down a little bit. So we're going to see if that's going to be a continued trend or not, excuse me. But the other thing that we're keeping an eye on is what's happening now that the forbearance period is closing. And now servicers, loan servicers, are going back to borrowers and saying, look, we're now at the end of this road of foreclosure relief for you. The forbearance periods are ending. And we're in a situation now where you're either going to have to sell your house or we're going to foreclose, or you're going to have to find some other option. And so if you have equity and you can't make your payments and you can't do a loan modification, so that's another metric we're looking at. Loan modifications were at an all-time peak high. And that's probably a result of the fact that we just came out of the end of the forbearance periods, right? So the end of the forbearance periods across the country have peaked. And now more people, we just hit a number over 5,000 forbearances, loan modifications. And we hadn't seen a number over 5,000 since the month before the pandemic. So we're almost back to our norms as far as loan modifications. We foresee a lot more coming in front of us. And so if you have equity in your house, you only have two options. If you don't want to lose that equity, you either do a loan modification or you find some other kind of foreclosure relief, or you sell your house, right? So if you don't qualify for a loan modification, because a lot of times loan modifications, the bank essentially is going to do a refi on you, is what they're doing, really, and stretching the loan out a little bit longer, adding the penalties and late fees into the loan balance, and then just kind of stretching it out, re-amortizing it for maybe 40 years, up to as long as 40 years, to give you a little bit easier monthly payment, because they don't forgive debt. They just stretch out your loan term. Right. Then you may have enough of a low payment that you can pick back up where you started. But sometimes the lenders want to see you before they put a loan modification through and approve you for that. They want to see that you can pay for 90 days. So they put you on like a test period. And then if you qualify, then they'll do the loan mod. But what happens if you can't do a loan mod and you have equity? You're going to have to be forced to sell unless you want to lose your equity and let your house foreclose, right? So you're seeing, what's interesting is we've seen a slow of the market, but of inventory, but it's not because of the buyers. It's because of inventory increasing. So we have 16% more inventory right now than we did before. And that's because more people are selling that were just sitting on their houses before. I don't know why that is. I suspect some of that is because people can't catch up. They can't qualify for a loan mod, and they have other arrangements and they want to sell their house to tap the equity for people who have equity. Right. Now, with our short sale processing company, we're coming across a lot of people who don't have any equity. And that may sound surprising to a lot of people because you look at some of the stats when it comes to, asset values across the board, stocks, housing, commodities, pretty much everything. If you own something, the value of it has gone up, right? Used cars, just inflation in general. Right. So if asset values have gone up, then you'd think, and down payments are heavier than they were like in 2008, then there's all these indications that we're not going to see a housing crisis like we saw before, or at least for those reasons. But we see a lot of people who came out of COVID and don't have the money to make their payments, can't qualify for a loan modification, and they don't fall into the category of homeowner we just talked about with somebody who has equity that's selling because of they're trying to tap equity. There's people who did VA loans, USDA loans, FHA loans, highly leveraged loans, and got some help at the closing table on top of that. So they almost were able to come to the closing table with $5,000, $10,000, move into a house. Well, what happens if a year or 2 years goes by, COVID shows up, and you can't get back on your feet again, and you didn't take care of the house? So now the house needs $20,000, $30,000 of work or $40,000 of work. And you already had a highly leveraged loan. You couldn't sell that and pay a commission and closing costs and inspection items and everything, much less the prep work you have to do to get on the market to come out whole for your loan. You'd have to come to the closing table with cash or sell it short of what was owed or do a short sale. Right. So our national short sale company, which coincidentally we turn on national marketing for next week because we see the timing for it is right now, is going to help people who are upside down. So you have probably 2% of all mortgages right now about that are in some type of forbearance window. And that doesn't include people who are before 90 days delinquent. So 30, 60, and 90, we don't even know about. But the people who are 90 plus, you're talking about 2 million homes. And you also have another 2 million, interestingly, 2 million homes that are coming down the pipeline through inheritance because of all the boomers that are passing on and passing houses that their kids don't want, interestingly enough,
right?
Because they only live in the same state. The house hasn't been updated since 1990. You know, they're more of a nuisance to these kids, and the kids want the money out of it. They don't want the house, right? So you got 2 million houses coming through probate over the next 10, 15 years. And then you also have, because boomers are dying, and then you also have the 2% of all the mortgages that are in default and some type of forbearance. So anyway, we know that there's going to be a percentage of those that are upside down, and that's what we're going to be hawking. So, you know, practical information. If I was an investor and I was looking at capitalizing on the market right now, I know, number one, if my dad asked me, hey, I want to buy a piece of real estate and turn it into a cash flow house, how would I go about doing that? My advice to him would be, number one, don't pay market value for it, because this is the time for selling, not the time for buying. So if you do buy, you have to buy it at a discount. Well, how do you buy a property at a discount? The best way to buy it at a discount is to buy a distressed asset. And there's 3 ways to buy a distressed asset. There's the pre-foreclosure phase. That's when the lender starts legal action to take the house back, which is their right when the borrower doesn't perform on the note. And then there is the foreclosure auction. That's phase 2. And then there's a bank-owned property or an REO listing, which is phase 3. Well, on that spectrum, the more competition there is and the more public the information is about that property, the less discount you have, because more people can know about it and it's easier to get. Right. So we look at that continuum there, and we're always trying to say, okay, where is the best place where the game is maybe more sophisticated, it's less public information, where we can get a better discount. And that's going to be on the pre-foreclosure phase. So that's part of the reason that one of the byproducts of having a short sale company is that we are exposed to deals across the country that we're able to negotiate with lenders to get an investor in those deals short of what's owed on the property, right? And a lot of times, even after your rehab cost is accounted for, your total basis on the property would be lower than market value, because they know they have to discount that property. It's kind of like a ding in your truck that you go to trade in for a new car. If it's a $500 cost to the dealer to fix, they're going to ding you $2,000 off your car for it, right? So we do the same thing with the lenders.
John, let me ask you this quick question. Let's walk through. Let's assume, okay, that you're able to you're able to buy a pre-foreclosure property. Let's say, for example, in Tampa, Florida. I mean, I love Florida. Florida has so much opportunities. I've been doing turnkey investment homes for my investors for so many years in Central Florida. So it's a good location. So let's make this hypothetical situation. Let's say you and your company are able to purchase a pre-foreclosure property. Let's say in the neighborhood, a similar property retail, let's say costs $250,000. 3-bedroom, 2-bath, single family home built 10 years ago. 1,400 square foot. And then the buyers that let go the properties, most likely they are VA buyers and FHA. You're right, they don't have enough equity. They are potentially upside down. So you buy it, then my investors will come to you. So as a retail investor, they want to buy from you, the wholesaler, so to speak. So depending on the rehab, let's say the rehab cost is like 10,000. Okay, I mean, nothing major foundational issue, just cosmetic repairs here and there. So as an investor buying your pre-foreclosure niche market that you're promoting, can an investor get financing? I mean, assuming the appraisal works and everything else in that neighborhood, can the investor, pay 20% down payment, whatever, 20 to 25% down payment on a loan, and then also, of course, the investor have to pay the rehab costs as well, in addition to the down payment.
I'll walk you through the process of buying a foreclosure or pre-foreclosure or a short sale specifically, because a lot of people, we come from an environment where back in 2008 to about 2009, 10, 11 were the peak of our foreclosures on our market. 70% of what was on our MLS, 7 out of 10 properties that were listings on our MLS were either short sales or bank-owned properties. So we come from a world where this is like second language to us because we were around back then, right? And active.
Yep.
So the way that you buy a foreclosure as an investor is a little bit, in some ways, it's very similar to buying a traditional listing in that you can finance it the same. You can have your inspection periods the same. You put up a deposit the same way. It's not at risk until after the lender approves the price that you're trying to buy it for. So really, outside of just sitting back and waiting, there's literally zero risk in buying a short sale. You just have to have your expectations managed properly. It could take 90 to 120 days to get approved, right? In the meantime, you're not at risk because even if they don't approve it, your earnest deposit comes back to you. So no harm, no foul. I'd want to have, if I was an investor, 20 different properties that I have deposits on that are completely refundable until I get an approval and my 10-day inspection period started, right? So from the time that the price gets approved from the lender, it's the exact same buying process if you bought a normal house. You got 10 to 15 days to your inspection period to kind of expose what's wrong with the property that you can't see. You combine that with the cosmetic repairs you want to update with a rehabber or local contractors to get it tenant ready, for example. And that those two combine equal the scope of your rehab. And then when you close on it, you get your financing just like normal. You can have a finance contingency in there just like normal. If you were going to buy your own primary residence, and then it would close after your underwriting and your loan commitment was done. And then you'd start the rehab, which we would project manage for you, and then take care of the property management as well locally. So all of that is exactly the same. Is the next question we get a lot of times is, well, what kind of discount would I get on a property like that if I went to the next question? But yeah, so that's a harder one to answer, and it kind of depends on the lender. Sometimes it also depends on the house. If you're in a condo, if you're trying to buy a short sale condo, and it's a 2-bedroom floor plan, and it's a community where there's 300 of those, it's very hard to prove to the bank that your condo, for whatever reason, is worth less than all of these 20 exact comparables, right? Because they're all the same.
Right.
If you have a house that isn't part of a subdivision, it's a little bit non-conforming as far as like its layout and everything. There's not like 10 of them exactly the same way in the subdivision because it's not a spec home, for example,
right,
and it needs some work. There's a lot more room there to, I don't want to say you're not playing games with the bank, but what you're trying to do is it's harder for the bank to pinpoint, hey, this is valued at X for sure. It's easier to say to the bank that, look, here's the case that we're trying to build the bank for a short sale, by the way. It's inevitable that you're going to have to foreclose on this thing. So if I can bring you a buyer at a price that nets you the same or more than you would pay if you were going to foreclose, then please accept my price, right? So if this is market price, but the house needs some work and there's a convenience factor and then this is the price here that we try to start them at, but maybe they land here. You know what I mean? So, and some lenders are just unrealistic. They want to go here for the short sale, and they say, I won't take $1 less than this amount. Well, it's not worth that when you consider the rehab and everything. So nobody buys it. They end up having to foreclose and looking like the bad guy and getting the bad PR and putting a foreclosure on a borrower's record. And then it goes on the market, auction. Nobody bids on it because their judgment amount's up here, and that's the opening bid. They don't discount it at the auction. They end up taking it back and then having to put the work into it if they do that, or they put it as an REO listing that needs work, and they still net less. So our job as a short sale processor or negotiator is to convince the bank that, look, we have to build two cases, that this is a strong buyer and it's inevitable that you're going to foreclose. And this price that they're offering you is going to net you more than if you were to go through this process yourself and foreclose and get the bad PR and then have to add more time to this process. So that's basically our job in a short sale process. And a lot of these deals, if they need some work, these houses, and they're like an entry-level good rental property that'll yield well, it's a great way for you to get in, because you have a higher likelihood of getting a discount on a property like that than you would if you were to go on the market and compete with something that everybody can buy, right?
Yeah.
And you're doing a great service for the owner of the property, because that owner now is able to, through a short sale, not have a foreclosure on their record. And in half the time of a foreclosure, get another home loan, get back on their feet again, and become a homeowner down the road at some point, as opposed to having the foreclosure. So there's a lot of advantages all the way around for doing short sales.
Yeah, I mean, wow, you have given some really good, like, real estate 101 with respect to a pre-foreclosure system. So great education, and so as a turnkey investor, we just rely, my buyers, my investors, for example, when they come to you, I mean, knowing that you and your team have the experience from the last real estate crash to draw upon.
Yeah, well, it hurt too.
Yeah. Plus the fact that you live in Central Florida, you know the market for a long time, and I love Florida. There's so much more opportunities. And number three, the additional value is, when investors buying property, depending on the rehab costs, you have to be reasonable in that you should be able to get 10 to 20% discount from a comparable in a neighborhood on that property. Plus, plus everything's done for you. I mean, you guys, you have your team, you have your rehab team, you have your inspector, you have the appraiser, investment loan agents, and your property managers,
yes,
all in the area. So same turnkey system, except pre-foreclosure is a niche market. Not many people understand it, knows about it, execute it. So it's not. So there's not a bidding war. There's no multiple listing. You're not competing against other investors, buyers, whatever. So I see a lot of benefit, a lot of value that working with you and your team with pre-foreclosure investment opportunities coming down the pipe.
Yeah, and I would say to investors, if you're considering, just understand when you're coming into a pre-foreclosure, you have, from the time, like, the good news is you're not competing with anybody. The bad news is you got to wait 60 to 120 days, 60 days on the very fast, like in a fast example,
Right.
And then maybe up to 120 days. I've seen even 6 months, where depending on the lender, to get a lender's loss mitigation team to say yes or no to a price that you're offering. And if they say no to the price you first offer, then what's our counter going to be? And can you meet somewhere in the middle? And is that going to still be worthwhile for you? So as long as you understand that, then it's a great way to buy. And if you're buying multiple properties, the goal would be then to get multiple projects under contracts. You get that process started right away. And then 3 months to 4 months later, you start to close on these properties that you're getting approved for at a price that you really like. And I would say at the end, after your rehab cost is considered, so let's talk about your total cost basis between the acquisition and your rehab, you're all in, you want to land between like 5 to 10% discount from market. So $300,000 property is going to give you about $15,000 to $30,000 of equity day one, or at least a margin or a buffer in case there's a softening of the market. And I don't see any other way to actually do that from us. There's no systematic way to actually get discounted properties, especially with the market the way it's heated right now.
Well, absolutely. I mean, we can, Central Florida. I mean, we have promoted through my team turnkey properties in Florida, all over Central Florida. Not, Orlando Metro. There's so many sub-markets in Central Florida. Tampa Metro, Orlando Metro. There's so many smaller cities like Kissimmee and Daytona and Sebring and there's so many smaller, like I couldn't even name. So there's so many. There are pockets. There's so many good pockets in Central Florida, with just so many opportunities. So it's really, if we can pick up, if our investors can pick up pre-foreclosure property through your system that are selling for, like, they can get it for $250K, get a 10 to 20% discount, incorporating the rehab costs and all that, and it should rent for about $1,900, depending on what neighborhood. And we expect a cash flow situation. There were plenty of renters out there. Right now it's a renters nation. So really, I know we're running out of time, but in my mind, buying of pre-foreclosures are not really that much different than what my investors have been doing, buying turnkey properties, except the new builds that we've been promoting, is very, very desirable, but new builds are very, very hard to get these days for many, many reasons.
Yeah, and you're probably, with the supply shock, you're waiting as long or longer than a short sale, right, nowadays.
Yeah, so the next thing is, so we trust you, down the pipe. We don't know when, maybe toward the end of this year, beginning next year, when we will see, the first wave of pre-foreclosure properties. It's not going to be that many, but that you have the pre-screening system to find the right property in the right neighborhood in Central Florida, whereby turnkey investor can.
Yeah, and to that point, not all short sales are going to be obviously good rental properties, right? So, we may be working on an $800,000 short sale, and that's not going to be ideal for a turnkey cash flow investor. So, the few criteria that we look at if there's maybe 5 short sales, 2 of them might be good rental properties because they're at a good entry level, affordable price where the rent is relatively high compared to the purchase price. So you can achieve that 5 to 6% cap rate, which is kind of like our bottom floor for yield. And that's based on a conservative vacancy rate and a maintenance reserve. So, realistic about those cap rates and how we calculate them. But if you can hit your yield requirement or your cap rate and it's at an affordable price, and going in that, okay, if anything, see, with new builds, it's nice because you have less physical risk because everything's brand new. So you have to worry about getting hit with like an air conditioning unit that goes out 2 years later. Well, with our rehabs, the way we calculate them is, the good news with us is we manage them as well. So when you have the accountability from the sales side and the management side, then if the people that are selling you the property and saying that your rehab is $10,000 to get it tenant ready, and it's going to rent for $1,700 a month, it's nice to know that the people who told you that you bought the property from are also the ones that have to fulfill in that promise on the management side, right? When it comes to the rehab cost and then also getting it rented. So we don't sell unless we manage, and we don't manage unless we sold it, right? So that way it keeps that alignment for our turnkey investors. But if the property doesn't check all the boxes from a yield perspective to, the price requirement that we're looking for, and then also we want a certain owner occupancy ratio in a subdivision. So that's probably the most important metric, because I get asked all the time, like, what do you look at for schools and crime rates and this? I was like, I don't pay attention to any of that. If you look at how desirable the neighborhood is from an owner occupancy perspective and how we measure that, I'll tell you in a second, then you have a property that will appreciate as equally as it will provide a decent yield. Because if you go into a neighborhood where 95% of the people in the neighborhood are renters and not owners, then on paper, you're going to have a 12% yield. But in reality, you're going to have people stealing your air conditioning unit unless you cage it. You'll have people leaving in a 6-month lease early. It'll be at the low end of the rent rates. It'll be a cheap property, but it's going to be a nightmare. And your return's going to be up and down, and you'll net 5 or 6% anyway, right? It's just a more stressful way to get there. So to avoid that, we look at owner occupancy ratios, where in a subdivision, if you have, we'll spot check 20 houses around the subject property, and we'll look at the tax records and see that we want to see that at least half the houses around it, the owner, the mailing address is the same as the property address. So if the house next door, the mailing address is different than the property address of the house next door, then you know it's an absentee owner. That means it's probably a landlord who's renting the house out, and they get the tax bill of the property goes someplace else to the landlord, right?
Right.
And then the house to the next door and across the street are also rentals. That might be a little bit of a red flag as far as appreciation potential or growth potential on that property, because it's not a place that owners want to move and pay a premium for, right? So if we get at least 50% owner occupancy ratio, that's another criteria that we're looking for on our rental properties as well. So owner occ ratio, good price, and a good yield. And you have the 3 main check boxes that we'd be looking for. And then it just so happens that maybe 2 out of the 5 of our short sales will fall into that category.
So what about the flipping opportunities? What if a price that you negotiated for our investor, or the price is above what is the cap rate for rental cash flow and all that? I mean, some of those property are like more than, like, for example, more than $300,000 single family home, 350, 400K, 500K, but since you can't cash flow because rent is not going to cover, the debt obligations. Some of those pre-foreclosure.
Can you flip it?
Yeah, you can flip it, right?
Yeah. We do invite some investors to come in and do private funding, to where they'll make anywhere from 7 to 10% ROI on their money per flip. So they'll fund the flip and the rehab, and then we cycle that money, buy the property, rehab it, and then sell it within 4 to 6 months. Right. That's kind of the target range. And if you do that twice in a year, you land between 15 and 20% ROI annualized, right? And you're liquid in between flips. So there's a lot of advantages of being private money lenders. The problem is we don't see a lot of volume with that. There's not a lot of those out there. There will be, but right now there's not a lot. And to do a flip, our benchmark is if the after repair value or the comparable sales, say that this property will sell, just to use round numbers, $100,000, then our all-in cost with the rehab cost can be no more than $70,000. Right. So if that house needs $20,000 a rehab, or $10,000 a rehab, let's say, then let's say a $10,000 rehab, then for $70,000, we have to have been able to buy the property and rehab it and be at that $70,000 or lower. That means the most we could pay for a house that would sell for $100,000 after repair and needs $10,000 of work is going to be $60,000. $60,000 buy, $10,000 rehab, where 70%, that's kind of rule of thumb. And then we would sell it for $100,000. But remember, that $100,000 sale price, you've got about 8, 9, 10% in disposition costs, negotiating, home warranty, inspection items. So we always take, to be conservative, 10% right off the sale price. That leaves you with 90% or $90,000 on that $100,000 sale that you walk from the closing table with. So you're down to making $20,000 on a, let's call it $70,000 out of pocket cost. And that's kind of the target range we try to shoot for. And that 20,000 is what we split with the private lender. They get an 8% preferred return on that money, and then 15% of the profit thereafter, which translates again to that about 7 to 10% ROI.
That's not bad. That's not bad short-term money. So, really, so when you're starting to promote these pre-foreclosure opportunities, me as an investor, so I'm hoping you're going to say yes to my question. And my question to you is, what type of investor you want to come in and do this kind of a niche purchase system through you? I mean, I know what you're going to say. I prefer a very sophisticated investor that have done some.
Oh, no.
Well,
Um,
that's not really true, right?
it's
Yeah, I agree. I bet you I could bring a newbie investor to you, as long as that newbie investor have common sense, can take any instructions from you easily, have an
yeah,
open mind, they have financial resources to do these kind of deals, right? Doesn't
it
have.
really is no different than buying a regular house. The only difference is you just have to know that up front, here's how it works. Okay, we have this pre-foreclosure. Here's what the cash flow looks like on it. Here's what the rehab looks like. We can project manage all that to eliminate acquisition risk, rehab risk, and then we even get a tenant in there before you close potentially, right? In some cases, because we'll even take possession and buy the properties and sell them. But for a new investor to buy a short sale is very easy. They just have to understand up front it's going to take 90 days to get the lender to approve the price. Now, here's the good news. If they don't approve the price, no biggie. You get your earnest deposit back if you don't like their counter offer, because they will counter. We'll get at least some price that they will accept.
Mhm.
I always like to go in low on the first one because I want to see where their floor is,
Right.
right? I want to get a no. But then I want to be able to say, okay, what will you approve? And then they come back with a number. So then we can say, okay, is that number going to work considering this rehab that we have, right?
Yeah.
So yeah, it's a newbie investors can profit from those just as easily as a sophisticated investor, as long as you understand it's going to take a little while, but there's no risk
Yeah.
outside.
I believe you. I mean, I worked with you for many years. I trust you, right? Because
Yeah.
I know you're very, very transparent. You have a good track record over the years, and we have done a lot of deals before. So we will.
Yeah, and some of those went sideways, but we stuck around, right? So it's like, oh, you did what was necessary to fix it. And I always like to say that you don't know what kind of girl you got until you break up with her, right? So you don't know in business really who you're working with until the market doesn't do what you expected to do. Things go sideways, and then how do you handle it, right? Because
Yeah.
nothing's gonna be perfect. So yeah, in our case, we've been through nothing has been perfect, right?
Well, you've been through the battle, you've been through the wars, you learn your mistake, and when you work with investors moving forward, you can coach them and instruct them not to make the mistakes, and this time you can do it right. So yeah, so I know we've been talking for almost 1 hour. I mean, great content. You just gave a very basic pre-foreclosure 101 that any motivated out-of-state investor can benefit. Whether they are 3,000 miles away from Florida, or as in our case, most of our investors are here in San Francisco Bay Area. But yep, we look forward to this very, very unique opportunities coming up. For the rest of this 2021, most likely the beginning of 2022, right? And little by little, we will see those kind of deals coming available.
Yeah, exactly.
Okay, John, any last word before I let you go? This is longer than we expected, but great content, great education. So any parting words before?
Oh, that's all I have. We know it's coming. It's on the horizon. It's just a matter of positioning ourselves now. Investors can do the same thing. Start talking to your lenders, get qualified, get your ducks in a row, set up your structures. If you're buying tax deferred, maybe you're doing cash or non-recourse. I know SeeWing, you're mastered all that stuff. So get everything set up now, get your LLCs ready, get everything ready now so that when it is time to react and buy, then you're not reacting to it when it's on top of you. You're actually proacting because you're already ready to go. So we're not ready to go deep into buying right now either. This isn't the season to buy unless the right deals come across our desks. That's a trickle now, but that spigot's going to turn on. So this is the time to start getting ready.
Yeah, so my buyers, as I prep my buyers moving forward after this call, for the rest of this year, my buyer will be either all cash or financing, loan pre-approval at 20 to 25% down payment, and also using a self-directed IRA. I'm educating a lot of my investors to do using their self-directed IRA to buy, and we will accept those resources as well, I'm sure. So many different ways to put the money in. So, okay, great. I have all your contact information. So any investors that are interested in working with you, I will pre-screen them. I will send you over after I pre-screen them and they will have your contact information. So I know how to reach you. So thank you so much, and we will very, very great educational. Thank you so much. Great opportunity for the foreseeable future. Thank you so much, Mr. John Chen.
Thanks, SeeWing. Take care.
We'll see you too. Bye-bye.